Good day, everybody. Welcome to the Deal Scout. On today's show, we're going to have a conversation about capital raising and real estate and all the fun things with taxes and capital gains and maybe how to avoid it or find another place
Absolutely.
for it, right? So, ladies and
Absolutely.
gentlemen, Eddie, welcome to the show, dude.
How are you? Great day.
It's a
Happy to be
great
on the
day.
show.
Yeah, glad you're here. So, Eddie, who are you and what do
Okay.
you do?
My name is Eddie Austin. I am the co-founder of JE Capital and manager of JE Capital Fund number two. We invest in real estate, mostly multifamily, all multifamily, and Class B, Class C value add opportunities. We raise private equity to be able to deploy that into multiple assets. We're a 506C fund.
What does 506C, right? So, anytime an acronym or some type of it's something that maybe the general public doesn't know about. Like I like to dig into that a little bit. So tell us, you're on fund number two, right? JE
Yes,
Capital number two. So you can
right.
talk to us about that. But what is 506C? What's that mean?
So 506C, you can do property level syndication through a 506C, means you can openly advertise, you can do general solicitation. And that's geared towards accredited investors only. Now you can do a 506B and you can raise capital with non-accredited individuals, but you cannot advertise over social media, nothing on any advertisements. And you need to have a relationship with the investor prior to investing. Um, there's a lot of there's a lot of gray area there. I know a lot of guys play in that space and they're good at it. With what we like to do with social media and everything else, 506C was the best fit for us. So we can only target accredited investors.
Copy.
506B is all non-accredited.
All right, got it. All right, so talk to us about fund number one. Tell us about what you guys have accomplished,
Sure.
and then maybe even how you got into this space.
Sure. So first, fund number one was more of a JE Capital tenant and common model. We raised a couple 100,000 for venture capital to start businesses. And it went really well. We tried to leverage that model into multifamily real estate. And it was with the people we talked to, it was a different model for what I'm usually doing. I usually come from building companies, stuff like that, being in bigger business. So you kind of get the instant rapport. You're not trying to fly under the radar. And that tenant in common model, when I went and presented that to people, they kind of felt like, man, is this a Ponzi scheme? Well, that really turned me up because I've never had that question asked anything I've done because I think I've always had a corporation or a business name. We were a brand. So we always got that rapport of, no, this is a real entity. It's a real deal. So we left that model and then we went to the 506C and then we built it into a brand and a corporation to where we were a big company. Now we're accredited by the Better Business Bureau. We have a large social media footprint. We're on YouTube, Instagram, and we're able to openly advertise, and it's viewed as a professional entity now because people can see what we do. We have nice websites with plenty of information on there. We actively post on YouTube also what we're doing, what we're looking at, Instagram. So, yeah, I think we had the backup. We tried to take that tenant and common model forward.
Hmm.
We just didn't get the rapport we were looking for. By building a fund, we're able to invest in multiple assets at the same time.
Copy. So how'd you get started? Give us your story. Give us,
Sure.
how you got to where you are, and I got some questions, especially about the VC route that you guys took. So
Yeah. So, first and foremost, I was the traditional W-2 worker, heavy in the industrial. Actually started, I was homeschooled after elementary school, and I did vocational school early. Did about 12 years old. I started in a welding place, production welder, with my brother-in-law's business. And from there, I was always in the professional industrial trades. Went to a large Toyota manufacturing plant, worked my way up from an employee all the way to top management. And 2008 through 10, being in automotive industry, it was surreal. I got to watch a lot of my people go. And that really bothered me. So from that point forward, I was really driven to build companies that could survive that. Now, at the time, I didn't know what that took, didn't even know what it meant, but I knew I was hungry to find what that is because I knew not everybody fell during an economy downturn. There was guys that did really well. So I was interested in who those people were and what they did to get there. So fast forward, we knew that we needed to start our own business. So we started a metal fabrication business. We built handrails to Pro Street hot rods. We had a lot of fun doing it. We've done some pretty cool and amazing things. And it actually helped us with our path to get where we were today, just because we got around the right people. So we're in the middle of building a sculpture for a motel in Owensboro, Kentucky. And I knew that the guy we were building it for, he was had a motel, and I knew he had some other things. So I asked him, what was 2008 through 10 like for you? And he said, well, it was great. It was the best years we had, and I was astounded. I was left my mouth open. So I said, man, please give me the secret sauce. Anything that can help. He goes, well, I'm not going to just give you the secret sauce because you need to learn it. Education's the answer. Mm-hmm. I said, okay. So what is that? He said, read financial books, success leaves clues, and follow the money. You're a smart man. You're an entrepreneur. You'll do great. Just study. You'll figure it out. So from that point forward, that's all we did was study real estate. We were already doing single family fix and flips, single family rental. We were already in that space, but we spent a lot of time to make a little bit of freedom. And it wasn't really freedom. We were working our butts off. My wife's a real estate broker. She's always been right beside me in everything we do. And running the business, running everything else we were doing, we wanted our time back. We weren't able to spend time with our kids. We weren't able to take as many vacations and have fun with other people. And most importantly, we couldn't save anyone besides ourselves. If somebody came to us and needed a larger lump sum of money to pay off some bills or something like that, we didn't have that overgross profit to be able to just give away. And that bothered me, as hard as we worked, to not be able to give back. Mm-hmm. So after that, with that meeting with that person, I knew he was in real estate. He told me that real estate was the answer. That's all I did, man. I dug into it like it was just, I was majoring in that particular space. Everything I could find, Bigger Pockets, listen to their podcast. The best book that turned my mindset around was Rich Dad, Poor Dad by Robert Kiyosaki. That got me to think differently because we're all in that mindset to get a W-2 job, mm-hmm. save your money, retire, buy a home, everything else. And that's so wrong. There's so many other ways to make money. There's so many ways to make money while you sleep. So through the studies, it come down to, okay, the super wealthy, the people that survive any economy or do very well in economy, it was people in real estate, large real estate. They either owned storefronts, multi-use properties. Most of it come down to large apartment buildings. So a lot of those guys, even Donald Trump, he used other people's money to buy and do some of these projects together, whether that be a venture capital business or raising equity to buy develop large buildings. So through all the real estate and investment books that I was reading, it all come back to, okay, so if you don't start with a lot of money, you have to turn other people's money into a nice profit to be able to attract them to invest with you. And you're giving back at the same time. So that was really driving me to really get into the space. So at that point, we said, okay, well, let's work on how to get started and how do we reverse everything that we've learned to get to where we want to go now. So now you got to totally reshape yourself from being a multiple business owner, real estate broker, and everything else we're involved in. Now we got to shut that stuff off because I felt the only way to go far is to singly focus on one thing, and that being real estate and raising equity. So we had shut down the hot rod shop. We turned loose of all the single family fix and flip opportunities. We let all that go. We got down now. We got one commercial building and one cabin that's a rental, VRBO, and we're rehabbing that right now. So we turned loose of everything else that was taking our time. And from that point forward, that's when we said, okay, well, we need to raise venture capital so we can get into this space and not have to worry about making money every day. Probably to back up, when I went in business for myself, is we always ran businesses underneath the W-2. So in the afternoons, we were doing all these things, the fix and flips, the running the hot rod shop. That was all 20, 25 hours a week. And we did pretty good with it, but we never really went very far because we weren't focused on that 100%.
Mhm.
When I left the W-2 in 2020, and that's all I focused on was the shop, we made great, great leaps and bounds. But there was one thing I think that is a pretty good seed for other people that want to be an entrepreneur. We're all bred over so many years to think that there's a certain number that you need to live on. For me, I always wanted to make $1,200 a week. I always wanted to make $100,000 a year. So at $100,000 a year after your taxes, probably about $64,000 a year, and then you buy a house and you get your car and maybe a boat, a couple other things. That $64,000 a year don't go very far. And there's not really a whole lot left to invest in a 401k or an IRA. So you're really left to work the rest of your life, which is what a lot of people that was underneath me I seen do. And that drove me crazy as well because I knew that wasn't the answer. But one of the most limiting things that I would tell people today, if you, it's so beneficial to be an entrepreneur and get your time back because that's the only thing we don't have control of is our time. We can always make more money. And to the point, I had always had in my mindset that I need to make $1,200 a week. Well, when I left that W-2, I had in my mindset, standing in my own company, I only need to make $1,200 a week. That was the most limiting thing my mind was ever bred to do. That was ridiculous because I now had the opportunity to make $1,200 in a few hours if that's what I wanted to focus on. And that's possible because you're not getting paid by the hour. You can do multiple things. You could do multiple things at the same time. You can make $1,200 a day. I originally wrote down the business plan that I need to make $400 a day, and that would suffice all the way through. If I work 6 days a week, it's pretty good money. And then I got to thinking, and nobody less than 40 years old needs to think like this. You don't need to be on a golf course. You don't need to be working 20 hours a week and you spend the rest of the day on the lake. Do that once you've made a bunch of passive income. So long story short, it was kind of a kick in the pants to say, hey, wait a minute here. You can make as much as you want. It's up to you. And I would tell any entrepreneur starting out that don't limit yourself. There is no limits in this game. You can make as much money as you want in the least amount of time as you want. You're no longer here getting paid for your time. You're getting paid to think. And if you think outside the box, you can make as much as you want.
Hmm.
And I think that's what's most important.
Yeah.
So you can get your time back. The time back's the only thing we don't have.
Yeah. So one of the things as an entrepreneur, I appreciate you sharing your story. One of the hardest things that I had is going from hourly, right? I grew up on a construction site, swinging hammers, digging ditches, right? Like
Yeah,
not
yeah,
the smartest cookie here, okay, guys? But going from that to then moving into real estate where it's value based. You do a deal, you get a commission, right?
right.
So going from digging ditches to, syndicating deals and investing and such like that was such a hard thing for me to go. And I'll tell you, the temptation's always there, right? Like I had a government job and it was stable and secure, didn't pay a lot, but I had, a pension and I could work there for 150 years and then one day live the life I want. But that was the hardest shift for me, is going from hourly or some type of salary
Yes.
to value creation, where I
Right.
could do a deal and I can make 14 grand in a day or something,
Yes.
that case. That doesn't happen every day, just full
No,
transparency.
but the opportunity's there,
Yeah.
especially if you're not in that previous mindset. And
Yeah.
also if you have the time to focus on that. So when you're on that W-2, you're focused on whatever you're paid to do.
Yeah.
Once you're outside that space and you break your mindset, then you're able to find a flip wholesale.
Yeah. Yeah. I I was having a conversation with a guy, and I'd love to hear your thoughts on this. He was an engineer mindset guy, and I was talking to him about some of the ventures I was invested in or working on. Dude almost had an anxiety attack just listening to the amount of risk and exposure and
Yeah.
like the
Yeah.
deals that I've lost. And he almost had an anxiety. Just he goes, I don't know how you do it, and I'm like, I don't know how I do it either, but I'm figuring it
Right.
out.
And that's an interesting point too, because I have several friends that's engineers herself, and they have that engineer mindset.
Hmm.
Everything is mechanical, and they're great people. And I love talking to those guys because they have such a different perspective on what we do and how we do things. And yeah, I've had that same culture shock of um, I don't know if that's the right method. I don't know if that's the right thing to do.
Yeah. The next thing that I had to overcome, and I'd love your thoughts on this, is, Eddie, is from not only when I went from trading, from time to dollars to
Yes.
value based and pure hunt. I only eat when I create value, right?
Hmm.
That's
Hmm.
active, to then passive. Hey, I
Right.
invest money, I might not get it back, but the goal is trickle in passive over time. That was a hard, or I'm in the process of trying to increase active and also pay attention to passive. That's where I'm at now personally in my life.
Right.
Like how do you approach that, and what are you doing to, improve your own mindset but also work with others on that?
So I think most importantly, um, one thing, probably a little bit off your question,
Yeah.
but it seems like real estate is one of those things to where you can be actively trying in the space and somebody's going to notice that you're trying in that space. And they will almost, without asking for a dollar, lend a hand to help show you or teach you ways to where you can do that active investment into a passive investment.
Yeah.
And there's so many ways to educate yourself to get to that point. So I think once you break that habit of being that trading that hour for dollar into thinking outside the box, you can do other things. There's so many avenues to learn. And, if somebody has zero experience with, say, large apartment building operations and rentals, then you can start in wholesaling. You can
Hmm.
start in just finding a good property or finding a good value and then giving that to a busy professional in that operating area. And they're happy to pay you a fee for that.
Totally. Yeah, so I got my start, well, I got my start super active, where I was listing people's, mobile homes in the middle of the
Mhm.
forest, or, like
Yeah.
trying to list all these properties, listings, right? And
Yeah. Right.
open a phone book. But then I got, I started finding deals, wholesaling deals, and I would make 14 grand. That was one of the examples when I just threw out a number. I made 14 grand from a door knock. And I was like,
Yeah.
wow, big difference. And I
Yeah.
didn't have to do all the work. An investor was lined up and they're like, I would love to do a deal like this, right?
Hmm.
So in terms of deals, in terms of things, like what are deals that you guys are hungry for? What kind of deals do you guys look for, and how are you guys executing on them?
Okay. So, in the business right now, it's me and my wife,
Hmm.
and she's a real estate broker. She's no longer selling. So, one of the first things we needed to get in front of us was deals. So, you needed to create some type of a deal source
Totally.
automation machine, basically. We sent letters, direct mail letters, stuff like that. And then when we started getting some traction there, I always evaluate your ROI on your time. So just like you were going out and looking for those opportunities, and then on a door knock, you turn probably, I don't know, a couple weeks worth of work and probably not making much on the mobile home sales to one door knock to an instant value opportunity that was probably a lot quicker and a lot less time on your side.
Hmm.
So that probably got you to just click a little bit. So for us, that click was, okay, we're sending all these letters. We're finding properties, but they're not exactly what we want. How do we hone this in to getting exactly what we want? So in our private placement random or on our website, you'll see that our opportunities are Class B, Class C, 10 to 350 units. That's a very broad focus. I think you really need to get laser focused on what asset you're truly looking for. For right now, we're looking for 100 to 200 door properties. We're looking in high growth, high population areas that have a tremendous amount of appreciation,
Hmm.
a strong rent growth multiplier. So we're looking for 2.5 to 3% on that rent growth multiplier to be able to continue to cash flow more every year, and in cities that can support that. So when we started looking the deal source side, we're sending these letters, we're sending them to all kinds of properties. We're getting calls back on fourplexes, sixplexes, and it was great, to get in front of people, but that wasn't getting us where we wanted to go. Then I started to, guess, hot call or warm call brokers. I would get on LoopNet and I would find a piece of property in the area I was looking for. I'd call the broker up and I would show. Now, things on LoopNet are usually that top dollar. They usually don't make sense. It's not what you're looking for. Sometimes you'll find a diamond in the rough, most of the time not. So I'd call that broker up and I'd say, hey, I'm interested in your property. I'd go take a tour. Most of the time I wasn't interested in that property at all. I was interested in the relationship because I seen that he had sold multiple properties. He had the type property I was looking for. So I would go walk the property. We would have a great conversation. And then I'd ask him, hey man, what are you doing next Tuesday? Would you be available for lunch? And see if I could take him to lunch. Most of the time they're busy. Maybe you cut the property tour short, and if there's not another one leading up, go out to lunch that day. Um, I guess kind of the thing, I would usually schedule my tours around 11 o'clock. So we might walk the property for about 30 minutes. And then if he wasn't super busy that day, I'd say, hey, why don't we go grab some lunch? Because it was kind of right at lunch time frame. So we'd go out to lunch and he would start to build a relationship to me. And then he would ask me about, where I come from. Everybody's interested in your story.
Yeah.
So then moving forward, the magical thing was the next time he got a property, before he ever listed that on LoopNet or any other platforms, he would give me a call or an email. Hey, I got a property. Are you interested in it?
Totally.
And you might hone that in that he might know, okay, he's only looking for Class B in this city, and he's looking for something that he can just go in and repaint the walls and replace the countertops, and he's looking for $200 or $300 a month. So then you kind of really hone in what you really want in a property. So it saves you a lot of time. So from that point forward, they would either send me one or I would call him up and say, hey, I'm really looking for a property. I need a property right away. And he might go talk to his friends or a management company, and they probably weren't even thinking about selling. But because that broker was working for me, he'd probably find a property that wasn't even an opportunity. So he would make more money because we're out here having him look for properties for us and creating opportunities that's not even available to the general market.
Yeah. Yeah, that's the benefit for, on the acquisition side is he can essentially scoop up properties and get both the listing and the buy side of things, if he
Correct.
structures the deal right versus you list something, then you have to build an external relationship with someone else. So that's why I like working with buyers when I was actively doing brokering because you can get an off market property and get the full commission,
Correct.
right? And
Right.
then if it's not a good fit for you, the person still might say, "Hey, still list my property. I do want to sell it. It just didn't work with this buyer."
Mhm.
So it's a great way to find listings and deals. As you're going through this process, what kind of milestones have you guys hit? What kind of successes have you guys had on the either the raise or the acquisition side or management
Right.
side? Like where, give me some success.
So success has been a fight for sure. It hasn't been easy. So when we wanted to start the fund and launch this opportunity, we started in May of 2021. Now,
Hmm.
that date was significant to me because I felt that that was when you're getting in this space and you've been in it a little while, you get really good at reading the market, understanding what things are getting ready to happen. You look at history and you kind of know what the economy is going to do, and you kind of have timing indicators that you pay attention to.
Hmm.
So knowing that we were pretty close to another economy cycle, we went ahead and launched the business in May of 2021. Now, what I did not predict was the government printing money like crazy and kicking the can down the road. That's something I didn't see coming. I also didn't know the name of what this might be called as far as what drives the economy down this time. So, with them printing all the money and inflation going the way it did, property values skyrocketed. So, I was looking for another 2008 through 10. I was looking for, we launched the fund. Everybody's afraid to invest in the stock market. Everybody's afraid to keep messing with cryptocurrencies or mutual funds, and they're looking for other opportunities. That was the real estate syndication fund. We would be invested in real estate. We still offer returns even in a down economy. So I would have that safe place to put that money. So from that point, we needed a property. So the problem is if you had a dog of a property or a property that was barely cash flowing, the one thing 2021 and even a little bit in 2022 provides, you'll sell that property somehow, some way.
Yeah.
If you got a property that you could not list and sell before because of the income and expenses, you're going to sell it today because the supplies are so low. So that we underwrote 25 to 30 deals a week we run across our desk, just underwriting properties, getting the deal sourced through the door. We would underwrite, we would do the due diligence, we would look at the debt, and then we would look at the syndication. We did that repeatedly. I
Hmm.
mean, repeatedly. And it come down to almost every time that the properties that we were looking at buying wouldn't even afford their own debt because the price was so high and the
Yeah.
expenses were high and the rents were low. So I know a lot of people in the space struggled with that. The other thing we found, the properties that were super hot that we were very interested in that made sense. There was a cash buyer out there with a 1031 exchange where he probably sold his 1,000, 2,000 units recently,
Yeah.
multiple properties, and he was sitting on a bunch of cash. So velocity of money was very quick for him. So when that property come available, and we were underwriting it for 2 or 3 days, 2 or 3 days was too long. It was already gone.
Yeah.
Or we put it under LOI or a PS or under close to a contract, and somebody would swoop in and do all cash.
Yeah. How do you in these kind of scenarios, right? Like what's your plan, what's your strategy for you guys are looking through deals, you're going through your due diligence, underwriting. People are so hungry for deals that they're overpaying for deals and they're
Yes,
they're,
they
you
are.
know, doing some things that could it's super interesting to me. But like how do you guys what's your plan on cash flowing and creating good opportunities when all deals are getting scooped up by 1031s or op funds or
Right.
hedge funds overpaying, right? Like
Right.
how are you guys approaching this?
So I think the most important takeaway to that
Hmm.
is sticking to what you know and don't fall in love with the property, fall in love with the numbers.
Yeah.
Um, if the location is right, you can't change the location. So the location needs to be perfect, or at least will be perfect in the next couple years, or there you can see the opportunity there. So
Right.
you have to know the opportunity headed towards that property. You have to read history or you have to read the future. Um, the second thing is be extremely good at your numbers. You have to know the numbers are strong. And for me, two things. Anytime I look at a property, I have to know that it's got a good feeling to me. When I step on that property, I know it's the right property. And then two, because I've underwrote it, I know the numbers well, I know the demographics well, and it's going to work. But when it comes down to a bidding war, I think it's most important to remove your ego
Hmm.
and remove your emotional attachment to the deal. Those two things will cause you to overpay. And most of the time, you're not paying attention to how much you're going to put into this property to the point that it's no longer worth it and you shouldn't have bought it. Perfect example. We had the unicorn of a property come across our desk from an off market broker. Same way, we built a relationship with him. He called me up. He said, I got 190 units in Texas. So, because we were looking at 100 and 200 unit properties, we knew from 100 miles away what a 100 unit deal to a 200 unit deal, the price per door. We knew what the income and expenses. We could tell you whether it was a good property in the first 2 minutes on the phone.
Hmm.
And that helped a lot to be laser focused on that type of asset that we knew it so well. So he calls me up. He goes, Eddie, I've got a property. It's 190 units in Southeast Texas. I said, I
Hmm.
like it. I'm getting excited. I'm taking notes. Got my notepad here. It's like I do now. I'm writing things down. And I said, how much? He goes, it's a Class B property. I said,
Hmm.
okay. Class B because of location, because there's a lot of other classes there. And people sometimes misclassify a property. You got your regular class, Class C of 30 years old, Class B of 20 years old, and so on. And I said, okay, so Class B. So what are you calling Class B? He goes, well, it's a 1978 property, but it has Class B amenities. I said, okay, all right. So it's got a pool. He goes, yeah, it's got a pool, community building, dog park. I said, man, I like the sound of this. And he goes, the operator just put about 700 grand into rehabbing the property, new roofs, new air conditioning systems. I said, okay. So immediately I'm kind of slowing down on my writing because I'm thinking the price is going to be $25 million. It's not going to be worth it. I said, what's the average rents? He goes, oh, the average rents are 950 to 1200 a door. And I'm thinking, I'm getting ready to hear the number. And I said, so tell me about it. How much? What are we talking? He said, you can do a loan assumption of 11.6 million. I went, 190 units, $11.6 million. And I said, what's the loan assumption? Immediately, not to get excited, not to lose your basis, stick to your education, stick to what you know. Don't jump on that, prove that it's worth it.
Yeah.
And I said, so can you send me the term sheet of 11.6 million? He goes, yeah, absolutely. He sent it to me, and it was terrible debt, probably 7.5, almost 8% interest, early payoff penalty, pretty steep, a clause in there where you could not refi, even for a new purchaser.
Really?
And I said, that's not good. I said, so let's get involved in this and let's ask the seller or the representing broker, whoever you're speaking with, what will they take straight out to buy it straight out? And he said, well, what are you willing to give? And I said, well, let's just ask the question first. And they came back and he said, 11.8 is good. He'll do 11.8. It's a $400,000 early payoff penalty. He'll eat two if you'll pay for two. I said, okay, let's do it. Fill out the LOI. We sent it in, and I'm looking at these numbers, man. And this thing's like 40% cash on cash return, 30% IRR to my investors. I mean, this is a deal like you just never see before. And it's pretty. It's going to look good on the website. We're first and best for like 2 weeks, but they wouldn't let us tour the property. They wouldn't let us start our due diligence, but they hadn't signed our LOI. So I knew they were waiting on something. So he calls me up about 10 days before Christmas. before the end of the new year. And he goes, Eddie, we need you to move to $12 million. There's one other buyer in there. Your terms are the same, but he's at 11.8. Will you go to 12 million? Of course, I didn't want to show him excited because I know the property's worth $20 million the first day I signed the closing statement. We got $28 million instant. We've got $8 million instant equity of the property, and it's a rocket ship of a deal. So I'm not going to say, hey, how much I'll give for this thing and to show emotional attachment to it. I said, I'll move to 12 million, no problem. We've redone our LOI. We sent it in. He calls me up about 3 hours later. He goes, Eddie, can you do all cash? I said, what's my due diligence time? They said, well, I need it to close before the end of the year. And I said, I'm going to play cards. I'm going to say no. No, it's not that I can't, it's that I won't, because I haven't done my due diligence. I haven't been on the property. I haven't done an environmental statement. There's no survey done. This thing might be built on an oil field. There may be toxic stuff all over the ground that I don't know about. I am not going to over leverage ourselves to be in competition. I won't do it. Mm-hmm. And just that point is the market is so hot. Don't get screwed up by that. Stick to what you know, stick to what you're educated about, and check the boxes. Make sure you have an environmental statement. Make sure that you're doing proper due diligence. Don't look at 10 units on a 100-unit property, because those other 190 units might kick your butt. Mm-hmm. And if you've over leveraged yourself on the price, you're done. And then you're going to get your first bad rap because you can't pay your investors. So no matter what we get ourselves into, we stick to the numbers 100%.
So what happened with that deal?
So I played cards with him. I said, no, absolutely not. I said, either number one, they had access to this deal before I did, which supposedly that couldn't have happened. I had access to it 2 weeks before anybody. And then second, either they know about the property or they're just being totally risky. I said, so I'm going to stick to where I'm at. I have a better number. My due diligence longer, but no, I can't close all cash. Not going to do that. My due diligence time stays the same. My closing time is going to stay the same. We're at 12 million. That's how we're going to do it. He goes, okay. So about 4 days after the new year, he calls me up, or 3 days after the new year, he calls me up. He said, well, they closed the property. And I said, no way. No way. I said, I want to know who. He said, it was a mutual fund company out of California. I said, do what? He said, they closed it in 7 days. They wired the money in 7 days. I said, do a property visit? He goes, nope. They never stepped foot on the property once. And I said, have they ever invested in real estate? Nope. I said, then why? Why? It makes no sense to me. So about a week later, we go to an investor meeting up in Indianapolis, and they had a loan person there that was big in lending, and he was telling us about the new lending programs like the bridge debt and conventional debt and institutional lending. Mm-hmm. And then he also spoke about mutual funds now giving loans on apartment buildings. And I raised my hand. I said, why? He said, well, we'll get to that, but they need returns, and their returns are coming out of the stock markets and other programs that they've used traditionally. And now they're looking at real estate because it's a more stable investment. And I said, I'm sitting here going, well, I wish they wouldn't, because I just got beat by the best deal I ever seen.
Yeah.
And, that money, that would have been an easy raise for that deal. 30% IRR, yeah. You'll get your money back in year 2. It was great. So long story short, he gets to the end of his presentation. He said, right now, at the end of 2021, there was $17.6 billion in dry powder and mutual funds. I went, why didn't they just say something? We could have put it in the fund. We could have invested in real estate. And they said, they've got to get this deployed into some type of investment that gives returns, because they're going to end up sending them balance sheets to their investors, and they're not going to see any activity, and it's going to be a bad deal. So they got to get their money out to the market. They got to get it deployed. And I'm like, well, what's their numbers? I'll deploy it and multifamily for them, and let us do it because we are experts in the market, or at least we practice to be every day. So let us do it because we know what we're doing, and they just do what they do. They bring money in, we give them returns back. It's a beautiful thing. So on that deal there, all they needed to do was just place capital. I don't know if they had some type of investment structure that they had to get that much deployed or what, but they just wired the money. Now, if somebody was in the office, knew what they're doing, I would say what they did is they'll turn around and flip that property. They'll probably turn around and relist it for $20 million.
Yeah.
And make $8 million.
Wow.
Or they'll just keep it and keep returns on it, or let some other big company buy it, but they knew it was a good deal.
Yeah. Wow.
Yeah, that sucked, man. That was a kick in the pants.
Yeah. So, man, my head's going so many. In the future, what will you do differently on a deal? Let's say you and I find that deal today. What would you do differently?
That's a great question. So that did, everything happens for a reason.
Mm-hmm.
And that reason got us to think, and it got us to think a lot. And the power of a real estate fund is you can raise capital for multiple assets. It's not a tenant in common model. It's not a property syndication level. So we have the ability to raise capital kind of like a blind fund where we can raise from multiple assets. We don't necessarily need to identify the assets. We can say we're targeting 15 to 20% IRR, 160 to 230% ROI, 1.9 to 2.5 on the equity multiplier. That's the targeted assets we're looking for. So that gives us the ability to raise. So we are actively looking to raise $20 million in the next 2 months for this fund, just for the reasons of, one, if we would have had $20 million in the escrow account at that time, and me and you found that deal, whether you brought it to me or I brought it to you, however that might be, we could have paid all cash ourselves for that property. And then we could have backed it up with institutional long-term debt, and it would have been a perfect picture. We would have probably called up several of our friends or other operators that's in Texas. We'd have probably had them meet us at that property, and we'd have probably had 30, 40 people running around doing due diligence over a few days. We would have rushed through an environmental statement, checked the boxes off, and we'd have paid all cash. So to learn from that, we've always been looking for that perfect property to be able to advertise and start actively raising. We shouldn't have done that. We should have leveraged the fund model to build targeting advertisement, to raise capital, to be able to deploy that at a minute's notice if needed.
Yeah.
To give us that velocity. We have the ability, and we had everything in our toolbox to compete with these big money people. We just didn't utilize it. So it was a lesson learned. Lessons cost money, good lessons cost lots. It's kind of like tuition from college, except you learn it a lot quicker.
Yeah, I've had a lot of good lessons in my life. Eddie, let's do this. I got a deck of cards with some questions on it. Tell me when to stop.
Let's stop right there.
Okay. Oh, wow.
Oh, I should have picked another one.
Who's an influential figure you wish you can make clones of and duplicate their character, who they are?
That's a perfect one. That's great. So my original influencer was Grant Cardone, especially because he does the same thing that we're doing. He does exactly what we want to be in the future. So he's a tremendous influencer. I love Grant's tenacity in the space, how driven he is. Trying to be careful here. So we want to become a lot larger than Grant. We want to be the next Grant. We want to be the next success story over that, and then be viewed as the next Blackstone or Goldman Sachs. We want to become 50, 60,000 units strong. That doesn't happen alone. And what Grant has is a large team. Now, Grant's business model comes from sales. Grant started in car sales to sales of sales for other people to marketing. And then he took his marketing career and turned that into real estate, and then started a regulation A plus to where he raises equity to buy large properties. I feel like we might have a pretty good opportunity to go very far because we are reachable. We are able to be, we're a relationship based company. We're going to build a relationship with you before you invest with us. We do get leads through the door where we immediately are asked, about our investment opportunity, and they want to straight invest. I don't like that model. I want to be able to educate you on what you're investing in and build the relationship before we ever talk about money. I do not care about transactions. I feel like Grant is a very transactional company. That's one thing we would change in our business model. We feel like might take us hopefully a little farther. But like I said, I'm not taking anything from him. I love what he does. Amazing person. It takes a lot to get in front of him. We looked at kind of a mentor program from him. It was 40,000 for me, 40,000 for my wife. I think close to 10 grand to get to his conference to be there. We were told that there'd probably be other investors there. And I said, at what point do I get to sit down in front of Grant Cardone and pitch him on my company to get him to invest with us or invest in one of our deals side by side in a partnership? That's what I'm looking for, is a partnership. And they said, well, for $2,500, you can do a VIP dinner where you'll be in the same room with Grant. And I said, so that still doesn't mean I'm going to sit down in front of him. No, that don't usually happen. So, that I was watching some of the sales funnels that he's got one of his guys doing today, and where it's, it's free. And then it's $50, and it's $97, and it's $5,000. And then you're investing $1 million into Cardone Capital. It's a sales influence. It's a powerhouse. I just want to figure out how to do it with less transactions.
Copy. Well, that's interesting where, the direction you guys want to go. During this interview, two things is one, what's the question that I probably should have asked you that I maybe missed? And then the follow up to that is, you could end it with telling us, where people could go to learn more about you and connect with you.
Okay. So first question was,
what question should I have asked you that I maybe screwed up and didn't ask you?
Oh man, I don't think you did. I think you went great. If anything, I probably went off the rails too much.
You're a relationship driven guy. You're a storyteller, right? You like to talk and to have conversation.
Right. There's multiple things that we want to do. I definitely want to be a motivational speaker or influencer to a lot of other people at some point. I listen to that stuff every single day. And I think it's powerful to keep your mindset very strong to where you want to go. Don't let negative thoughts in your mind. Don't let negative people be around you. If they are, go somewhere else. That motivation, that mindset is temporary, in my opinion. So is motivation. So you got to write your goals down. You have to be sure that you're driven. I think anything that you're not passionate about, you should stop immediately. Discipline comes into play where you'll do something, even if you hate doing it, you'll still do it because you have to get it done. But you have to be passionate and driven to be able to get there. And in this company, we're 100% passionate about it. We are very, very strong on the word of extraordinary, being extraordinary. As you see on my wall here, make your money being extraordinary. Mm-hmm. That's 100% us. We want to get around extraordinary people and offer extraordinary returns. That's what we want to do, is be able to help a lot of people.
So for our listeners, people that listen in and they resonated with what they said or with what you said, they want to learn more about you, maybe do a deal with you. What's a good place for people to connect with you and do that?
So our landing page is JE Capital, and that's Juliet Echo Capital. And then you have INV, so JE Capital, INV.com. You can also find our investor portal at invest.jecapitalinv.com. You can find us on Instagram. You can find us on YouTube. You can Google or you can go on YouTube and look up Eddie Austin. Eddie Austin is basically me from where I come from way back in the business to what we're doing currently. We also have a JE Capital YouTube page. You can find me or my wife, Eddie Austin, at LinkedIn, Jennifer Austin on LinkedIn. Facebook, we got Facebook. We have, find us on the Better Business Bureau. You can also Google us, our office here in Tell City, Indiana. Multiple places. And my phone
Quite a
number
few. Yeah, go for it.
is our business phone is 812-739-3413. That's 812-739-3413.
Very cool. Eddie, thanks for coming on the show. Fellow people, fellow deal makers, especially in the audience, if if you want to connect with our guests, all their contact information will be in the show notes below. Connect with them if what they're saying resonates with you. If you are working on a deal specifically, want to talk about it here on the show, head on over to thedealscout.com, fill out a quick form, maybe get you on the episode next. Till then, talk to you all on the next episode. See you, everybody.